TowneBank Mortgage is an equal housing lender. NMLS number 512138. This is not a commitment to lend. Welcome, everyone, to the May edition of Wilmington Mortgage News here with TowneBank Mortgage. And I am one of your co-hosts, Tyler Cralle, and with me, as always, is David Macaione, sales manager here of TowneBank Mortgage Wilmington. And David, good seeing you.
Hey, Ty.
A lot to get to.
Yes.
A lot happened in May. Some of it kind of a rerun, but we do have some optimistic signs. So as always, I want to make sure we get compliance.
Compliance is important.
Compliant, I guess, is the term to be using. David's NMLS number is 117378, and mine is 2028201. So now we are compliant and we are good to go. And let's start, like we do every episode, with what happened earlier this month. Start of the month, we got the jobs report. And just a reminder, the reason we're looking at the jobs report is because that is one of the Fed's mandates, is to see what's happening with employment. And when employment is too hot, the theory goes, I believe it's the Phillips curve. The theory goes that when employment is too hot, that means inflation is going to be too hot. So
because of wages.
Yes. Because if you can't find people to work, in order to keep people, in order to try and entice people to jump from job to job, you have to pay them more. And so wages go up, which causes labor costs to go up, and on the cycle goes. And so the Fed has been really hoping that we're going to get some kind of disappointing jobs report. And once again, the jobs report blew the predictions out of the water. Economists were expecting 165,000 jobs created in April. And in reality, it was 253,000. So almost 100,000 more on an 153,000 expectation is a lot more than they were expecting.
You know what I haven't looked at is the graph of the last several unemployment reports. Are we trending down?
We are. I mean, If you look at like 2022, I think we were averaging about 400,000 a month, and now we're averaging like high twos.
Okay. So
we are trending down, but every single month we do better than expected. So it's kind of like an expectation thing, as the market, whether you beat earnings by $1 or miss by $1, all that matters is what was expected and how you did in comparison to that. And so every month they're like, here's the expectations, and they beat it. And so It gives the impression that we are, hotter than we should be. And it is sort of disappointing, unfortunately. I mean, it's great that people are working, but we keep seeing these jobs reports come in hotter than expected. And it's got to be frustrating, the Fed and Powell.
Yeah. Well, I mean, it seemed like they were going to just keep raising until it broke, until we got a negative jobs report. Now, you and I both know that they took the sentence out of their statement that implied a possible pause, right?
Yeah. Well, they raised at the beginning, almost right after the jobs report came out, they announced that they were going to raise rates, and we all knew that. And they took basically, I think it was like a word out, or it was something where instead of saying they expect to raise rates, they basically said that they're going to wait and see what happens, which led everyone to believe that there was going to be a pause at the next meeting. But then Bullard came out and was like, I don't know, maybe we are going to raise rates.
Bullard said, 2 more this year, possibly.
Yeah.
And then Cash Carey yesterday said 50-50 for June.
Yeah.
So, and those are two actually pretty dovish Fed governors. So,
well, I mean, here's what's kind of the good news. Looking once again, let's just stay with labor, then we'll move on to inflation. Here's kind of what's happening besides the big jobs report, is that we do have two reports that are also important. So one we get weekly, of course, is jobless claims. That has been trending upward, especially since they changed their formula for how they were calculating it. That has seen a big jump up. So that is, higher than it was 6 months ago. But job openings, the JOLTS report that we get the same week that we get the big jobs report, that has been showing something interesting. So last month, we saw a big drop. And then at the beginning of this month, we saw another big drop, about 500,000 fewer job openings than we had the prior month. And so job openings have now fallen to an almost 2-year low. And a lot of times, the job openings report is sort of a front runner for what's going to happen with the labor market, that once you see kind of job openings fall off, all of a sudden maybe companies aren't hiring like they were. And so then maybe we will finally see a worse than expected jobs report. But it has been interesting because for the last 2 years, this JOLTS report has been, I mean, we hit over 10 million first time, I think, since they've been calculating this data, and it's just stayed there persistently. And so this is the first indication that we are seeing a loosening of the labor market.
It has to happen. The Fed has raised rates 500 basis points.
It's like I know we say that every episode, like it has to happen.
I know we just seem to be having the same episode. We're talking because nothing has changed except rates.
Yeah.
I mean, we're still waiting for the same thing to happen. We're waiting for the results that the Fed is trying to achieve, and I think we're getting close. I mean, we're probably going to, in the next month or two, we may get a surprise jobs report, a big negative one. I've seen it. It's been it's been many years, but then, then just one day, boom.
Well, it's interesting too, because everyone sort of laughed when Jerome Powell was like, hey, I still think we can get a soft landing. But what is interesting about the fact that we're having the same conversation, going back to what we mentioned with regards to the jobs, is that it is trending lower. It's just nothing is happening dramatically. It's a slower kind of trend. And if we were to get the, soft landing, keep your fingers crossed, that'd be nice. That's how it would happen. It wouldn't be dramatic because that's when things get kind of chaotic. So maybe that is a good sign. I'm trying to be optimistic.
I don't remember any soft landings. That's the problem.
That's what they say. We've never seen one.
They always want a soft landing.
Yeah.
That's not what they get.
Yeah, they do always say, I think this time we can get the soft landing.
This time is different.
It's hard, That's what do they say? Like the Fed, you just keep raising rates till something breaks and then you stop. And if you're breaking something, you're probably not going to get a soft landing more than likely, which of course brings us to inflation data and CPI, which the Fed doesn't look at, but the markets do, and we certainly do. And here's some good news. The headline rate was supposed to hold at 5%, but it actually fell to 4.9. Now, you can interpret that many different ways. I mean, we'd like to see it get back down to 2. But it is still falling. It's slowing.
It's trending the right direction.
Trending in the right direction, but it's not a dramatic move.
Here's one thing that's important, and of course we know the Fed's not. CPI is not their favorite.
No.
PCE is, which is this Friday.
Yes.
And at least in relation to the CPI, we now actually have the Fed funds rate higher than the CPI rate.
That's true. Yeah.
Which I don't even remember the last time that was.
Well, it's funny because you always tell me how was the standard. That's what it was supposed to be.
Yeah. I mean, in normal times.
Yes.
Now, if the Fed was cutting rates, you should have interest rates below the CPI or the rate of inflation. And when the economy's rocking and rolling, which it has been doing, you should have the Fed funds rate above the rate of inflation. So we're just now getting to be above the rate of inflation after 500 basis points, which that's not the point of this show, but that tells you just how far out of whack the Fed let things get.
Well, and also just how out of whack the sort of economy is. And it's why you see people who have been, economists for like 40 years just perplexed by like, well, we're doing this. Why isn't this happening? It's like, oh, well, because this has been this way for so long.
Because of 14 years of 0% interest rates, and then how many $1 trillion of giveaways?
A lot.
Eventually, that became way too much money chasing too few goods and services, which I know people, people laugh about that now, but I'm like, look, that's the basic definition of inflation. What the cause of inflation?
Yep,
it's not transitory.
Milton Friedman, that's what he said. Inflation is everywhere and always a monetary phenomenon. That was famously said by Milton Friedman. I did want to kind of break down what is interesting about this CPI report, and that is food and energy, which were for the longest time persistently pushing up inflation,
right,
are now putting downward pressure on inflation. In fact, the core CPI data is actually higher than CPI because energy is down year over year and food is about flat. And
right.
So that I think is it's putting downward pressure on that number, which is different than what we've been seeing for the last 2 years, where food and energy we're pushing it up.
Well, anecdotally, I can speak to that because you always heard me talk about my bag of onions. I like to cook. I like to go grocery shopping. And for years, we had a bag of onions at Harris Teeter that was $1.29.
Yeah.
And now it's $2.99. But the point that I have noticed is that food costs seem to have leveled off at a much higher level than they were 2 years ago, but they seem to have stopped going up.
And I did say year over year. I meant flat month over month. They're still up like 8%.
Big difference.
That is a very big difference. And then what is interesting, and this is good news, especially for us in the housing sector, shelter costs, which is always sort of a controversial metric here in the CPI report, which looks at basically the cost of housing, is whether you're a renter, whether you're a buyer, whatever it may be. Shelter costs fell 0.1% to 8.1%. And mind you, that 8% number is something they've never seen since they've been calculating this cost. That was thanks to the monthly increase slowing to 0.4%, down from 0.6 in March, in the lowest increase since February 2022. So we are seeing some relief from the housing sector, which has been, once again, a big driver of why that number got as high as it did.
A lot of people think that the shelter cost is going to be the savior to the CPI.
Yeah. Well, I mean,
it's going to bring it down fast.
I think it makes up a third of CPI. So the fact that it's the highest it's ever been, I think 8.2% is what it peaked at. And then that's 1/3. I mean, you have to have everything else pretty low to get down to 2%. So that's a big factor. And then I did want to mention this because this was I went back and looked at what was going on a year ago. So in 2002, May and June both saw big jumps in consumer prices. They saw a 0.9% increase month over month. And in June, it was 1.2%. And the reason I bring that up is that the next two reports, those numbers are going to fall off.
Right.
Because they were from the year before. So we could see a big move in the CPI because those big numbers fall off, which could give the impression that, oh my gosh, things are really kind of calming down, when in reality, it was more of the craziness that happened a year ago. And so I think everyone does need to be prepared to see maybe a big drop, and then that doesn't necessarily mean that things are dropping that quickly. It's just what was going on last year.
No, it'll be a good temporary move, but then moving forward is going to be that much more important.
Yeah. Well, what I also did was I went back and looked at where, the month over month data every single month from last July, which is when we finally kind of calmed down, and we're trending at about 3.5% year over year. If you look at all the monthly increases, which is still well above the 2% target rate that the Fed's looking for.
It's better than 9%.
It is much better than 9%, but it does give you an indication that we still need to see these month over month numbers fall back to either flat or 0.1, 0.2% instead of these 0.4 numbers that we keep getting. And there is some optimism to that, which is producer prices.
Right.
Which, of course, front run consumer prices. We have seen some tremendous drops with producer prices. And then the latest report looking at April, the year over year number fell more than expected, down to 2.3%, which is the lowest level since January 21. So that's like right when we're coming out of the pandemic, like the depths of it. And 2.3%, I mean, that's almost a target rate. I mean, the Fed would love to see that in a CPI number.
You just wonder if all of it'll make its way through to the CPI.
Yeah, I mean,
it's hard to get. Yeah,
it's hard to know what the lag's going to be, because for a while there, that PPI number was just skyrocketed and it wasn't immediately being reflected in consumer prices. And then finally, producers were like, we got to raise prices, like with these prices that we're paying for these goods. And so now, how quickly are they going to adjust? That's the big question. And if you look at retail sales, they might adjust quicker than we think. Retail sales in April fell 0.4% month over month, and retail sales remained down 1.6% compared to the same time last year. So there's no doubt that they're being there's no doubt that consumers are finally reaching a breaking point where they're pulling back on spending.
There's another big number Friday along with the PCE. Is it retail sales or durable goods?
Durable goods. Yeah, we already got retail sales.
Yeah. So I guess.
Yeah, so retail sales are down about almost 2% year over year. So you're finally, and mind you, these are not adjusted for inflation. So the fact that, retail sales were up 1.6, but they're not adjusted for inflation. So you assume that the inflation rate is, we just looked at it, about 5%. Actual spending is down about 3.4%. So people are spending less.
So the big question is, what does all this mean for mortgage interest rates?
Yes.
And it means that rates have been doing the same thing they've been doing for, I don't know, what, the last 5 or 6 months or even longer. We've been going between 6 and 7%. And right now, I think the one thing we haven't talked about today is this malarkey, That's really not my word. I don't know where that just came from. But, you know.
You're channeling Joe Biden.
Yeah, is that his
That's
word?
his word.
Oh,
That's his favorite word.
No. Well, I have another word in mind, but it's probably not appropriate. You know, this debt ceiling debate, we've seen interest rates, we've seen the 10-year Treasury sell off 8 days in a row. It wasn't too long ago the 10-year broke down to almost 330, which is a line in the sand that it can't seem to get through. And now this morning, last time I looked, we were at 375.
Yeah.
So we've lost 40 basis points in the 10-year over the last few weeks.
Do you think that's debt ceiling?
I think in short term it has to be.
It seems like it's got to be, because I can't see anything else that would be causing.
No, because
that.
we just talked about it. Even though the employment was greater than expected, it's still trending down. Inflation is definitely trending down. You know, if you believe the numbers, they're going the right direction. And the Fed did come out and say, or it took some verbiage out of its statement that implied, hey, we're raising rates every time right now. And now they've taken that out. So they've given themselves some latitude not to cut, but to at least not raise. It won't be a surprise if they don't raise in June, unless maybe something like we get a really super strong, you know, May employment report, or the next week's. I mean, the next big number is this Friday's PCE. I mean, it's the Fed's favorite measure. That better go the right direction. So I think that we're stuck in this range between 6 and 7% on a 30-year fixed until. Well, I mean, not that much longer. I mean, either inflation is going to continue to trend down, and like we said, the shelter costs are going to help. Those two big numbers from a year ago are going to drop off. And, you know, we just need, I hate to say it, but we need to see unemployment increase a little bit, and that'll make the Fed feel like they can go on pause. What we don't want to see is the mistakes that occurred in the early 80s, where they paused and it was too soon, and then inflation shot up again, and Volcker just had to put the hammer down. You know, we don't want to see that.
No, we don't. And what's also interesting is that, once again, we talked about this in the last episode, the spread between the 10-year and the 30-year fix, which continues to be relatively high to historical standards.
Very high.
Almost double. I mean, I think I saw today it was like 330 almost.
And I remember, to me, it was usually, let's just call it 2%, 1.75. So even if that historical spread just fixed itself, we could see interest rates fall 1%.
Yeah.
Without anything else, we could see mortgage interest rates fall 1% with no other interest rate making any kind of move. I don't know if that's going to happen, and I don't really know the full reason why that's happening. You know, what they say is because no one wants to buy these mortgage-backed securities at these levels because they think that rates are going to go down and they're going to refinance.
Yeah.
You know, and that's true, especially if we're just above historical levels for no real good reason. I mean, to repeat myself, if we see the spreads come in, there could be a refinance boom.
Yeah, I mean, it is sort of weird. It's like this chicken or the egg. Like, what's going to happen first? Because if the spread drops, that could then be, you know, an encouraging sign, which could then cause rates to fall even more. But if nothing budges, then it budges, and so it's kind of weird. It's like which is going to move first? That's going to cause those rates to fall.
And not that I don't want to see interest rates go down, but I mean, having been in the mortgage industry since 1985, you know, I've seen much higher rates for a much longer time.
Yeah.
And I can tell you right now, rates are not the problem. Inventory is the problem. I think you had some good data about that.
No, we do. So there's not a ton of data, but there's two main reports that I look at. One of them's from the National Association of Realtors. That's kind of like the gold standard. It's been around for a while. And they have inventory levels at 1.04 million, which is up 1% from a year ago, which is crazy because last year inventory levels were so depressed. We're only up 1%, which leads you, we're not seeing a lot of increase in inventory. But here's where things get really weird. So Altos Research, great outfit. They do weekly data. Every week they release a report. I watch it. Very fascinating. And they have shown over the last, I think this week in particular, we saw an increase for the first time in 3 weeks. But what I like is Mike Simonson, who's the CEO of Altos Research. He's very data driven. And so when the data changes, he changes his predictions. It's kind of like that old, I know John Maynard Keynes gets quoted with saying this, but I'm not sure if it was him, where he says...
It was him.
Yeah, where the facts change, my opinion changes. Like, what do you do, sir? Like, he's very good at being like, hey, this is what I think is going to happen, but, if this changes. And so he's always kind of saying, he's been very surprised by what's been happening this spring because he projected 2 months ago that we were going to see a big uptick, and it looked like it was going to happen, and then things just hit a brick wall. But here was this amazing stat that he had. So he said most years... by mid-May, available inventory has grown by 15 to 20%, which of course makes sense that, you have this sort of very, during Christmas time, beginning of the year, it's just not a lot of housing activity. So not a lot of people list homes. So as we move through the year, 15 to 20% increase. This year, available inventory has shrunk by 14%. I mean, so that's not only is it 15% below where we should be, we're now 15% below where if it was flat. So it's like double. It's twice as bad as it should be, which I think just goes to show you.
I can tell you that. I mean, people are making offers above the purchase. I just had people make an offer that was 10% above ask. The house appraised for half the difference. And they're not even budging. They're not. The seller says we're not coming down off our price, and the buyers are like, all right, we're going to come up with the money.
Wow.
They knew it going in.
Yeah.
And that's not uncommon right now. People used to freak out when appraisals came in short. Now they're like, okay, yeah, we knew we were paying probably a little too much, but that's just because there's nothing out there.
Well, and so here's what's interesting is that what's interesting about this data that's coming out is that you're seeing sort of because of where rates are and just because of inventory levels, demand has fallen. So you would think that a lot of these reports coming in would be negative, but here's what's fascinating. Home builder confidence, which under normal circumstances, low inventory or just demand being down and rates being higher, you'd think home builder confidence would be pretty bad. However, this last report that we got for May, home builder confidence jumped out of negative territory for the first time in 10 months, was at 50. And they straight up said it in the report. They said, because there is such little inventory out there that even though, we're still dealing with some supply chain issues, we're still dealing with, rates being higher and people sort of concerned about that. There's such little inventory out there that we can build and still make it profitable because we are the only game in town. Like that's the only thing you can do.
They really are. This is probably the best real estate downturn for builders that I've ever experienced. Yeah. And you know how that is because they have their preferred lenders very often or their own mortgage companies in most cases. It makes it a little tougher on us as well. Yeah. So I need those houses to be bought and then resold when rates go down.
Or you need someone in an existing house to buy the new house, and then now that house is available for someone to buy. But yeah, I mean, that surprised me that we saw this home builder confidence jump. It's actually what's kind of fascinating is last year, home builder confidence reached its peak at the end of 22, or end of 21. So every month in 22, home builder confidence fell to the point that it dropped in December. And then every single month this year, home builder confidence has gone up. And so it's just, I mean, we're still working our way through this is the way I look at it. Like we're still not near normal. No. And I think people need to realize that we're still seeing just sort of a weird housing market where you have low inventory, but home builder confidence is up. And I know the new home sales report came out today, and it was supposed to fall 3%. It actually increased 4%. But what was amazing for us here in the South, new home sales jumped 17.8% in the South, and the South now makes up 65% of all new home sales across the country.
Think of that stat. 2/3 of all new houses being built in this country are being built and sold in the South.
Yeah.
Wow.
I mean, it's crazy because you look at the other data and you're like, man, the Northeast, it's like, 5% of new home sales.
And we're not seeing it with new construction again because a lot of the builders have their own mortgage companies and they're giving huge incentives for the people to use. Now, again, when we get through this, all those new homes will now be existing homes, and hopefully some of those will come on the market when the rates do go down. It seems like we've had the same show 4 times over because we keep saying the same things. Eventually, it's going to break. There's going to be a negative unemployment report or employment report. We're going to see the inflation numbers move one way or the other. But I'm past the point. There was an initial shock for several months with interest rates going up, and there are people that are waiting for rates to go down, but that's not it. It's about inventory right now because I have people that would buy a house tomorrow if they could find it.
Well, and also it's interesting, you mentioned the buyers having their own mortgage companies. A lot of our builders, and what a lot of builders do if you look at sort of the fine print, because a lot of times you'll see these, especially in places where they're trying to move inventory, where they're not as lucky to be in the South, where new home sales are flying off the shelf. A lot of them are doing like temporary buy downs and things that we do, and so don't be thinking that just because they're advertising something that it's not something that we can do here at TowneBank Mortgage.
Exactly.
I mean, and so that's I think also sort of a misconception. It's like, oh well, I couldn't get that rate at a regular mortgage company, and maybe, but sometimes you can't.
Yeah.
And so it has been, like I said, kind of an interesting time for housing, and we're still not sort of balanced that out yet. And so hopefully it comes soon. But it is interesting to talk about in the meantime.
It'll come soon enough. We just need the supply-demand imbalance to correct itself, or at least get better, at least move in the right direction. Like you just said, what inventory fell 14% when it should have been up to what? I mean, that's just totally backwards.
Yeah.
So we're a year and a half into this. We're probably another 6 to 9 months of the imbalance, and in the rates, I have a good feeling that interest rates by the beginning of next year, which is really now only 6 or 7. I mean, it's the end of May.
Yeah.
I think a lot of people were hoping for this spring to be the end of it, but that would have only been a little over a year. I think next spring is where things will normalize. But my opinion is, if you find the house you want, you should buy it now. And I said this last time, because if you're waiting on interest rates, there's other people waiting on interest rates. And if rates do go down into the mid to low 5s, you're going to see a lot of people come out of the woodwork, and the inventory is not going to be there. So you're going to be competing against even more people. So if you find a house you want, you have to overpay a little bit for it. Do it. Get a mortgage that's somewhere in the high 6s, and then refinance when the rates go down. Because if the rates don't go down and the inventory does not correct, you're going to be happy you bought now. You're going to be happy you bought either way. So, I've just seen rates at these levels. I know it's easy for me to say. Everybody's still, the people that are younger or just have a more recent memory, they think of 3% mortgages. We're not going back to 3%. I'll bet money.
You don't want us to go back to 3. That means something bad happened.
Yeah, that's true.
We get to 3, it means something bad happened in the economy.
COVID 2.
Yes, rates are 3, but I lost my job. It's like, you don't want that. Like, what we want, I mean, a soft landing would be great, but we'd love to see rates get back, you mentioned, in the 5s, and have a robust, strong economy, especially when AI takes off and does all of our jobs for us, and we can just sit back with a cocktail. We
could let AI do the Fed's job, right?
I'm still not convinced that Jerome Powell's not AI.
He's
very stoic no matter what's going on.
That brings to mind a lot of movies to talk about. I actually quoted Terminator to my father-in-law last night. He was talking about AI.
The first one.
He said we shouldn't turn there are people who think we shouldn't, let the machine or let AI have control of the computers. I said, that's what the Terminator was all about.
Yeah. Well, I saw a great quote on Twitter, and it was something along the lines of, a machine, will never have to answer for its decision makings, and that's why a machine should never be put in charge of making decisions, because that's the whole point of making a decision. If you're wrong, you face a consequence, and if you're right, obviously that's great. But if you're never facing a consequence for making a wrong decision, what's to stop you from just making a decision willy-nilly? And
right.
So we can go to a whole AI podcast.
Yeah,
later.
We should probably save that for another show.
That's very true. So basically, the point, the whole takeaway from all of this is essentially there's just a lot of data out there showing that we're kind of on the brink of, I think, finally getting to a place that we'd like to be. But as David said, a lot of other people are waiting for that too. And so when that happens, we could see demand, because remember, demand right now is depressed from where it had been. And so there's a lot of pent up out there. And so if people are waiting, you could see a lot of people in line also trying to get a house. And then all of a sudden we're back to 2001. Well, hopefully not, because that was insanity. But a little hotter market than I think people are expecting. And right now, even with inventory levels depressed, there's still options out there for people.
Oh, there are lots of options.
Yeah.
So give us a call.
And also, it's a good thing people are finding out buying a home is a good hedge against inflation.
Sure it
is. We don't know what's going to happen in the future. I think the era of low interest rates, of low inflation might be over. We might see more normalized inflation going forward.
Too much money chasing too few goods and services. I can assure you there's a lot of money out there chasing too few houses. That's what's going on, because we don't even talk about the cash deals.
Oh, yeah.
I'm sick of hearing about cash deals. An agent says, I've got 3 clients I'm showing, 2 are cash. And, I'm like, all right, what about the one? Well, they might pay cash.
Come on, people are doing that.
We need that cash to run out.
Well, the Fed's pulling it back, slowly pulling it back. All right. Once again, if you guys have any questions about what we do here at TowneBank Mortgage, you can give us a call. You can visit our website, TowneBankMortgage.com, and talk to any of our loan officers here who can answer any questions that you might have about the process and even about some of those programs that you might see advertised and say, hey, is it something that you guys offer? Or they also might be able to dispel some of the myths about some of the fine print of some of those programs that get advertised. So once again, give us a call, visit our website, and we will talk to you again in June. Hopefully, maybe we'll start seeing some different reports. But until then, David, as always.
Until next time. Yeah. All right. Bye.